Welcome. In the previous lecture, we saw the concept of interest and time value of money. Like how does the value of money increases with time, or how we can predict the present value of money that we are going to earn in future. We saw simple compounding, simple interest, compound interest, and then also we saw the concept of annuity, capital recovery factor, and then we derived several compounding and discounting factors. Now in this lecture, we shall see as how all of these concepts can be used for evaluation of a project. Evaluation of an ongoing or sponsored or a proposed project is, in terms of its economic feasibility, is very important exercise. The project owner or investors, those are associated with the project who invest money in the form of buying shares or stocks, they try to get better returns on their investment, and their perception of the entire project is based on the concept of return on investment. But in addition to monetary returns, there are several other returns of the project, and these are the social returns, the community development of the country. Okay. So state as well as central government offers many incentives to entrepreneur who want to implement new projects. These are in terms of capital subsidy, reduced tariff on power, water, ease of norms for various emissions, gas, liquid, solid emissions, then various tax exemptions, tax holidays, exemption from sales tax or reduction of project import duty. So they somehow try to encourage the entrepreneurs to take up new projects. The primary objective of the project owner and investor is to have as high returns in terms of money as possible, plus the social returns that will follow. Obviously, a non-polluting healthy project will always bring economic and social benefits to society and government. For the evaluation of various projects for production of the same product, these can be evaluated on the basis of various financial parameters or ratios. Now, all of these parameters and ratios have some subjective element. For example, the desired rate of return on investment will vary from one organization to another depending on the capital investment, whether the capital is completely internal or it is in terms of some debt borrowed from financial institutions, or it is in terms of both debt and equity money that is borrowed from issue of shares to the public. So depending on capital investment, the desired return on investment will vary. It will also depend on the operating cost, and finally the overall state of national economy. Most of the project evaluation techniques are elimination based. That means they will indicate which project should be dropped rather than telling us which project should be implemented, or selection. Okay, so it is more of elimination than selection. The final decision of the project owner would depend on the risk analysis, the business acumen, and the market assessment. Now, here we shall mainly evaluate project on the basis of monetary returns. So the investment opportunities of a project from financial angle is assessed using different yardsticks. The most popular and effective method for project evaluation are break-even analysis, incremental analysis, then ratio analysis, and the discounted profit flow technique. Okay. Now, each of these techniques have their own merits and demerits. We shall see these techniques one by one, starting with break-even analysis. Now, this technique is mainly used by the production management to evaluate the profit or loss of any project. It would reveal the capacity of a project under consideration at which all costs, operating as well as the annualized fixed capital cost, are equal to the revenue earned. Okay. So that point we note. This is a technique used by production management. It is essentially the capacity of the project under consideration at which all cost the production cost or operating cost as well as the annualized fixed capital cost. Are equal to the revenue earned. The market survey report that is generated at the time of project conception, it gives an estimate of the project cost of definitive capacity based on the demand supply analysis, and based on this the break-even capacity is computed. Now, if the break-even capacity is more than the assumed capacity of the project, then it is concluded that the project should not be considered, or it is a non-viable project. If the break-even capacity is very much lower than the assumed capacity, then the project is worth studying further. So, that point we note here. If break-even capacity is higher than assumed or proposed capacity of the project, then it means that project is non-viable. On the other hand, if break-even capacity is much smaller than proposed capacity, project is profitable and should be studied further. Now, the final decision will be substantiated by way of other project evaluation criteria in support of this. So, this is not the sole criteria over which the decision will be based. Final decision, at point we note, final decision is supported by other evaluation criteria. Now, there are certain assumptions in break-even analysis. In the first case, we assume that all expenses can be bifurcated in terms of fixed and variable cost or production cost. Then second, market conditions are ideal. Whatever is produced is sold immediately. There is no inventory or finished products, byproducts or co-products. Then we also assume that the selling expenses are fixed as some percentage of the sales. Then fourth assumption is some fixed charges are not dependent on the capacity utilization. These fixed examples of these fixed charges are the interest charges on term loan, depreciation, salary and wages, factory overhead and administrative expenses. Then we also assume that the estimate of project cost is carried out for definitive capacity, and then the break-even analysis is done. Now, all of the fixed charges are added and indicated by F. Let us try to derive an expression for the break-even capacity. We assume that F is summation of all fixed charges. Then the variable expenses are denoted by V, or this is operating expenses or total production cost, whatever you call. And the variable expenses are expressed as rupees per ton. Okay, so it is per unit expenses. These would include the cost of raw material plus utilities plus chemical consumption plus the sales expenses, setting up offices, sales offices in different part of country, then transportation at the sales site, then warehouses, local warehouses to store the products. Those are the sales expenses, plus the administrative staff employed at that particular sales location. So all of these are included in sales expenses, plus packaging and forwarding or transportation. So these are all summed up under variable expenses, which we denote as rupees per ton. Let X denote the quantity of sales in tons. Then S is the selling price per unit. This is again rupees per ton. Now at break-even capacity, all the sales accruals match with the variable expenses and fixed expenses. So at break-even capacity, all net cash accruals, we have already derived a formula for this in previous lecture, equate or are equal to the variable expenses plus fixed charges. So S, that is selling price, rupees per ton, into X, the production, ton, is equal to variable cost per ton into the production capacity plus F. So X, the break-even quantity of sale, X is equal to F divided by S minus V, or percentage capacity, percentage break-even capacity is 100 into X divided by the total planned capacity or total proposed capacity. Now you can see here that the break-even capacity is directly proportional to F and inversely proportional to S minus V. S is the total revenue that is earned through sales. So the difference S minus V is high if either S is high for a given V or V is low for a given S. We can earn higher revenue from sales if we have a monopoly of any product. Okay. However, this situation may change with globalization, when other international companies will also enter the market and they make the same product available at a cheaper price. So S depends on the total market demand and the prevailing market price. Okay. So that is a factor dependent on many other situations. I mean, it completely dependent on government policy and the overall scenario of the market, so on and so forth. Okay. So what we can do is that we can reduce V. Other means of lowering break-even capacity is to have lower variable cost V through lower price of raw material. That is one case. Now, or more efficient process which has lesser utility consumption, so on and so forth. Okay. Now, low value of F can also bring down X. Lower value of F means superior and cheaper technology requiring less capital investment and manpower. Okay. So that point we note, X decreases if S increases or V decreases or F decreases. S increases if we have product monopoly, V decreases if we have efficient process requiring cheaper raw material and less utility, more energy efficient process, and F going down, fixed charges going down, means we have superior and cheaper technology requiring less capital investment and manpower. Okay. So, that point we note here. So, under these circumstances X will be smaller. Now, we have to take into consideration the overall operation of the project over a long period of time, maybe 10 years or 15 years. If the profit X being low means the project is more profitable. That point we note, the lower the X, the greater the profitability of the process. However, if the profitability becomes very high, then it will attract other players or other investors in the business, and that will result in more competition. So, very low break even is not preferred. Okay. That point we note here, very low break even which would attract more businessmen, more business companies, resulting in more competition, which will bring down S for us, is not desired. Then, what is the typical value of X? The typical value of X is about 60 to 65%. Okay. So, as a rule of thumb, for a viable project, the break-even capacity should be about 60 to 65% of the plant capacity. Now, this means that break-even occurs in the very first year of investment. Now, we must note this point, that although we have made the total capacity to, let us say, 100 tons per day, right from the first day of operation, the plant may not reach that capacity. The typical capacity utilization is 60 to 65% in the first year, then it increases to about 80% in the second year, and from the third year onwards, or third year it could be, let us say, 90%, and from fourth year onwards you have full capacity utilization. But if the break-even capacity is 60 to 65%, that means you have the break-even in the very first year of production, and which is a desired. This indicates a good project. Now, break-even capacity helps the project owner in deciding the minimum production capacity. However, if the production capacity is increased beyond this, much higher than break-even, then it may result in reduction in price. So, the analysis may not hold true. Of course, the V also will go down because of the economy of scale. However, S will also go down if more and more product appears in the market. So, that is about the break-even analysis. Now, let us see the second concept, that is incremental analysis. This is the second yardstick for evaluation of a project. Incremental analysis evaluates the increased returns or incremental returns, that is a better word, over incremental investment. Now let us see this with an example, numerical example. Let us say I have 3 projects. Project A, B, C. The first project cost in lakhs is 2000 or 20 crore. The second project has investment of 2400 lakh or 24 crore, and the third project has investment of 2800 lakhs or 28 crore. The profit after tax in these projects, again expressed in lakhs, is 400 for project A, 550 for project B, and 600 for project C. Now let us see what is the incremental analysis. However, we first calculate the percentage return on investment for these 3 projects. For the first case, it is 20%, 22.9% for B, and 21.4% for C. If we assume that desired rate of return on investment is 20% or higher, then all of these 3 projects qualify. But then which one to choose, A, B or C? Now let us see what happens if we go from one project to another. Okay? Or now we try to answer a question as how extra benefit we will get if we move from project A to B and from B to C. Project A has least investment. Project B has highest return on investment, and project C has highest total profit. So all of these 3 projects have some merit. Okay. Now let us see when we go from A to B, project A to B. We invest extra 400 lakh or 4 crore. However, we earn 150 lakh extra profit or additional profit. Then the return on extra investment is 150 by 400, that is 37.5%. Let us say what happens we go from B to C. Here again we have to invest extra 4 crore or 400 lakhs. However, this extra investment will increase our profit only by 50 lakhs. So the return on extra investment is 50 by 400, that is 12.5%. And now let us see what happens if we go directly from A to C. Here we have to invest 800 lakh extra. However, our profit increases by rupees 200 lakh. So here the return on extra investment is 20% or 25%, sorry, 200 by 800, that is 25%. Thus, it means that considering the minimum desired return to be 20%, one can say that incremental analysis, by incremental analysis, project B looks more attractive, because here the incremental return on incremental investment is highest. That point we note. project B looks more attractive as it has highest incremental return on incremental investment. So, that is as far as the incremental analysis is concerned. Now, we see the third type of evaluation, that is ratio analysis. Now, there are three different types of stakeholder associated with chemical project. Okay. First are the project owner or entrepreneur, then but it we also include in it the project promoter. Okay. That is the people, the institutions who lend money for setting up project. Stakeholder associated with project. First, project promoter, that is entrepreneur plus financiers. Okay. Then financiers we can put separate, entrepreneur, that is, then second is the term loan lender. Here we can put the financial institutions, banks. And finally, the people who invest money in the venture in terms of shares. So, the public investors who invest in terms of shares and equity. Now, the interest of these three stakeholders is different. Let us see what is that. The promoters are interested in early payback of their investment, the people who invest their money, entrepreneurs. Then the financial institutions or project financiers, they are interested in proper repayment of the term loan plus the interest payment of the interest of on the loan as per agreed schedule. And finally, the public investors or the shareholders, these are interested in the stock market and they wish to have good price of the shares as well as high dividend on the share. Now, we can evaluate the project from all three angles, from promoters angle, from the financial institutions angle and public investors angle using simple ratios. Now, what are these ratios? The first ratio is the performance ratio. The second, so this is for the entrepreneur or project promoter. Then the second is the financial ratio. This is in the interest of financiers, financial institutions, banks who have lent the money for setting up the project. And finally, the stock market ratio. This is for the public investors or shareholders. Now, some of these ratios are for ongoing project and some of these ratios are for new conceptualized projects. We shall see these ratios one by one. Now, let us see the performance ratio. These ratio indicate as how a project performs or is performing depending on the return on investment. So, the performance ratio indicates how an ongoing project is performing or a proposed project would perform Now this is based on the return on investment. So return on investment increases with risk. So we have to consider some basis for evaluation of performance ratio. So the basis often adopted is the zero risk venture. And this is, in most of the cases, is the fixed deposit in bank or the interest on fixed deposit in the bank. That means we evaluate returns on any investment done in a chemical project in comparison to the return that we will get if we invest the same money in the form of a fixed deposit in a nationalized bank, which is the safest risk-free investment. Now obviously the return on investment should far exceed the return on fixed deposit to attract the investor. Only then the investor would be ready to invest money in a project. Okay. So it is not just increase, but I have put 3 greater errors. So the return on investment in project should be much higher, significantly higher than return on the fixed deposit. Now how do we quantify this, or how do we estimate the return? The first ratio is the payback period. The project has to earn money to pay interest on the term loan, the working capital, the corporate tax dividend. Therefore, the concept of time when project can recover investment is highly significant. So the payback period is based on concept of time over which an investor will recover capital invested. After payment of the dividend, the term loan, working capital, corporate tax, so on and so forth. The exact definition of payback period is then the time required to realize profit or gross profit, which is equal to the total investment, that is the project cost plus working capital. That point to note, the time required to realize profit, this is of course the cumulative profit, gross profit, which is equal to the total investment. That is the project cost, capital investment plus working capital. Profit per year here is calculated on the basis of 100% capacity utilization, which is obviously not possible, as I mentioned before. In the first year, about 60 to 65% of the total plant capacity is utilized. Okay. However, when we estimate the profit, it is on the basis of 100% capacity utilization. In some cases, when we consider the project cost, we consider only the depreciable investment of the project cost. Okay. So that point we note, the fixed capital investment includes only the depreciable investment. Instead of gross profit, if we consider the operating profit, we define payback period as project cost. Two ways of defining payback period. project cost plus working capital divided by gross profit or operating profit, that is profit after tax. Profit after tax and the depreciation fund. If we use that, then we have to take only the equity part of fixed capital, because the debt will be paid through the depreciation fund, okay, and interest on the debt is already subtracted. So that point we note. If operating profit is taken to define payback period, we need to consider only the equity portion of fixed capital and not the debt. And here we also note that operating profit is gross profit minus the interest on loan minus depreciation fund. So we assume here that the depreciation fund is used to pay the debt or the principal portion of the debt. Interest is already subtracted. Now payback analysis will tell us as how soon investment is recovered, but it will not tell us as what happens after investment is paid back. It does not give the total profit over the notional service life of the project, nor it gives the present value of the return on investment beyond the payback period. So payback period has several limitations, but still it is a good way or a quick way of estimating the profitability of the process. So that point we note here, that payback period does not tell us what happens after capital is recovered. It does not consider the time value of money. Now the second ratio that is used is the rate of return or return on investment. ROR or ROI, return on investment. Now this is defined in a number of ways. Okay. The easiest way is the gross profit per year divided by the investment. The second method is, second way of expressing ROR is operating profit per year divided by investment, or the third method is the profit after tax but before depreciation. Divided by investment. So this is it. So this is a very easy method of estimating the profitability of the process. Another ratio that is used is return on equity. The money that is borrowed from public. Okay. ROE. ROE is defined as gross profit minus the interest minus the corporate tax divided by equity. Now this is of course per year. Now gross profit can be calculated using 100% capacity utilization, while financial expenses is the interest or the interest is during the moratorium period. Okay, yeah, yes. Now another ratio that is used is the profit margin ratio. Profit margin ratio is defined as the ratio of profit to the sales. Gross profit to net sales. Another performance ratio is the net assets turnover. This is defined as the ratio of sales to investment. However, this ratio is mainly for an ongoing project and not for a new proposed project. Okay, so that point also we note. This is the ratio of sales to investment mainly used for ongoing projects. Net asset turnover is equal to net sales divided by net fixed assets plus net current assets. Now, if this ratio is high, it reflects the ability of a project owner to make good use of the resources. Okay. For an ongoing ratio, if this ratio declines, then the project owner has to take measures to increase the sales. Now, this particular ratio, the profit margin and return on investment, the last three ratios that we have seen are related. Okay. So, the relation between return on investment, then profit margin and net assets turnover is ROI is equal to profit margin into the net assets turnover. So, these were the performance ratios which are from the viewpoint of the entrepreneur or the project owner. Now, let us see some ratios from the term loan lenders, the financial institutions viewpoint. Okay. Financial ratios. The first ratio is the debt to equity ratio. Now, one point we note that all of the financial ratios, they reflect the ability of the project to meet the short term and long term liabilities. Okay. That point we should note here before we go for to the definition of the ratios. These ratios reflect ability of the project to meet short term and long term liabilities. So, first financial ratio is the debt to equity ratio. Debt is the borrowed capital from banks or other financial institutions. Then equity is money borrowed from public in the form of shares. Okay. Now, high term loan, if the debt to equity ratio is high, okay, then it indicates the faith of the financial institutions in the project. Okay. Now, high debt to equity ratio are seen for mega projects which are of national interest, such as a petroleum refinery. Then the second ratio is the interest cover. This is defined as the gross profit divided by the interest. So, as the definition suggests, this is the ability of the project to service the term loan by way of interest. High ratio is good sign for both project owner and financer. Okay. Now, the numerator could be profit minus tax in some cases, okay, that is the operating profit divided by interest. So, the higher the ratio, the better it is for both entrepreneur as well as the financial institutions. That point we note, the higher the ratio, the better the project. Okay. Now, the third ratio is debt service coverage ratio. Now, this is defined as the ratio of profit after tax plus depreciation by straight line method plus the interest divided by interest plus the loan repayment installment. This is again mainly for ongoing project. So, these acronyms we define here. PAT is profit after tax, then DEP is depreciation but by straight line method, then interest, INT is interest on term loan, and LRP is the loan repayment installment. Typically, DSCR, this debt service coverage ratio, should be about 1.7 for a viable project. Then finally is the current ratio. Current ratio is defined as the ratio of current assets to current liabilities. Now, again this ratio is relevant for ongoing project, not for a conceptualized project, and it reflects the ability of the project to convert the liquid assets into cash to meet the liabilities of the business. Okay. So, that point we note here. It reflects ability of the project to convert liquid assets into cash. To meet the liabilities. Today we have seen various methods of evaluation of the project from viewpoint of the project owner, entrepreneur, from the financial institutions. In the next lecture we shall see this ratios, performance ratios from the stock market point of view. However, all of these ratios have the demerit that they do not consider the time value of money. So in the next lecture we shall also see the discounted profit flow analysis, which takes into account the time value of money.